Good afternoon. My name is Nico Jude Manibusan, and this is a presentation on sensitivity analysis and capital budgeting for American Military University Fundamentals of Business Analysis. Professor is Dr. Richard A. Monahan. For today's agenda, I will define what a sensitivity analysis is, go over the quantitative steps. I'll combine both of them together to create a demonstration. I'll also answer a question about incorporating risk into capital budgeting. I'll provide one more example, and then I'll conclude the presentation. So what is a sensitivity analysis? First, it's a technique used in business cases that involves making assumptions about a business's activity. It acknowledges uncertainty when businesses make educated guesses based on assumptions, creating room for marginal error. A sensitivity analysis is used to observe changes in outcomes, including metrics such as payback period, internal rate of return, net present value, or earnings before interest rates and taxes. Key variables and inputs for sensitivity analysis include interest rates, discount rates, sales revenue, COGS, fixed expenses, and marketing expenses. These inputs enable a business to make better informed decisions in uncertain environments and answer what-if questions based on multiple perspectives on a project by analyzing both best-case scenarios and worst-case scenarios. And it's important to understand that businesses make capital investments, new factories, new products, based on forecasts. Sensitivity analysis tells us how robust these forecasts are under different scenarios. Qualitative steps in a sensitivity analysis focuses on the initial conceptualization and assessment of the analysis before factoring in numerical calculations. First, establish an objective for the business case and define what decision you are supporting. The next step is to identify key variables that are expected to influence the financial outcome of the proposed business activity. These variables include assumptions such as shifts in consumer behavior, competition in e-commerce, technological advancements such as the incorporation of AI technology, regulatory changes, and including the introduction of carbon taxes. The next step is to classify critical drivers. Is this variable external, internal, controllable, uncontrollable, and is this data qualitative or quantitative? Next, you want to seek qualitative judgment from a management or experts to estimate a range of all possible values. Prioritizing values based on what outcomes measures what matters the most, and define what thresholds leads to failure or success. Ask important questions like what happens if sales drop by 10%, or what is the outcome if a discount rate changes to 20%. Once the previous steps are completed, it is essential to document the findings that will now be used in our quantitative steps, where we can add numerical values to our assumptions. After completing the qualitative steps, we can start to factor in our numbers. First, we need to create a base case by establishing a baseline scenario by assigning best estimate values for each variable. Next, we want to quantify changes mathematically by creating alternative scenarios. We can do this by increasing or decreasing percentage rates to reflect possible changes in the outcome. Now, it is essential to utilize historical data or managerial judgment to establish realistic targets. Next, we can summarize outputs and further explore the target analysis. Summarizing each scenario will help examine how sensitive each output is, such as profits for IRR, changes in assumptions. For example, a minor change in the discount rate may have a significant impact on profitability, whereas doubling sales may increase the net present value. Finally, we need to interpret the results and identify variables with the highest impact on outcomes. Document all findings and use this data when making decisions. Let's assume that we're a company that manufactures gym equipment. The first thing we want to do is construct the business case for selling the gym equipment based on conducting a qualitative review to identify potential costs and benefits. Then, we want to quantify these drivers by inputting numerical values based on educated estimates. This could include COGS, selling price per unit, and discount rates, or marketing budgets. Next, we're going to review the list of inputs and identify which is the most uncertain. Using the example of selling gym equipment, we can consider variables such as selling price, unit sale volumes, and the cost of manufacturing the equipment. Now we can create different scenarios based on negative sales, higher manufacturing costs, or pricing pressure from competitors. Finally, the company can measure the impact on different outcomes, such as IRR, NPV, or discounted payback period. Once concluded, we can summarize and interpret the results, comparing the magnitude of other changes and outcomes and enabling the company to make informed decisions about moving forward with an investment. Incorporating a project risk into capital budgeting can be done by using the SRA method, by adjusting the discount rate for riskier projects. When a project is at a high risk compared to other investor projects, the firm's WACC increases to reflect its higher risk. Now remember that increasing the discount rate will decrease the net present value, and using a scenario analysis will allow a firm to use key variables such as sale volumes and inflation to generate the base, best, and worst case scenarios. Firms can estimate the outcomes of a project for each scenario. Using this method allows a firm to assess the range of sensitivity of the return on investment from each scenario by computing the NPV, IRR, or payback period. For this example, let's imagine that we're a company trying to launch a new line of commercial gym equipment, and its standard WACC is 10%. However, factoring in assumptions such as high competition or uncertainty regarding the need for new gym equipment due to something like the COVID-19 pandemic makes the project riskier. Taking a look at this table, the management applies 3% premium, raising the discount at 13%, which reduces the NPV and makes it less likely that the project will be approved unless the expected cash flows are strong enough to justify the risk. The best case scenario predicts sales of 2,000 units, leading to an NPV of 500,000 and an IRR of 13%. The best case assumes the sales are 1,500 units, with an NPV of 250,000 and an IRR of 13%. Now the worst case scenario would be selling 1,000 units, and this projects a negative NPV of negative $50,000 and an IRR of 8%. The management's decision would only continue if the best conditions are expected or if the company can find ways to mitigate the risk. Now this can be including partnerships or involving marketing campaigns. Wrapping everything up, I want to kind of go over everything I just talked about. First, we learned that sensitivity analysis is a tool that businesses can use to evaluate the impact of uncertainty on investment decisions. It analyzes how key changes in variables such as sales volume, marketing expenses, or discount rates can affect the financial outcome. And a sensitivity analysis combines qualitative and quantitative steps to improve decisions made on behalf of the company. Firms can understand the risks of each project and make informed decisions. Incorporating risk into capital budgeting through risk adjustments enables a company to utilize data to inform its decision-making process and ultimately develop more effective investment strategies. Once again, my name is Nico Manabusan. This concludes my presentation, and here is a list of references that I used to create this product.